Imagine paying $2 for a $1 bill. Not by accident, not because you misread it, but because you truly believe that's the smartest move in the room. That's exactly what's happening right now in the stock market. A company whose main business is holding Bitcoin is being valued at nearly double the Bitcoin it actually owns. Wall Street knows the math. The institutions understand the numbers. And they're still lining up to buy it. This isn't a meme coin frenzy. This isn't retail speculation on the fringes. This is pension money, mutual funds, serious capital. So here's the question that's been bothering me. Are we witnessing financial genius exploiting a loophole in the system? Or are we watching one of the most expensive trades ever quietly build in plain sight? Because if you think this story is about Bitcoin, you're missing something much bigger. There are moments in markets when you don't just question valuations, you question reality. The moment I realized that a struggling enterprise software company had effectively transformed itself into a leveraged Bitcoin vault, I felt that shift. Not curiosity, not excitement, something closer to disbelief. Because this wasn't a startup pivot. This was a public company rewriting its identity around one of the most volatile assets on Earth, and Wall Street applauded. Welcome to Financial Mindset. If you're someone who doesn't just want headlines, but wants to understand the machinery behind them, consider subscribing. These are the kinds of stories that deserve more than surface-level reactions. Back in 2020, while most corporations parked excess cash in U.S. Treasuries, MicroStrategy made a radically different decision. It converted its reserves into Bitcoin. That alone was bold. But what truly caught my attention was what came next. They began issuing convertible debt, borrowing money, not to expand operations, not to build products, but to buy more Bitcoin. At that point, this stopped being a treasury strategy. It became something else entirely. And I couldn't look away. But the real moment everything clicked for me wasn't when they bought Bitcoin. It was when I looked at how the market priced it. Today, the company holds roughly $70 billion worth of Bitcoin. Yet its market capitalization floats around $138 billion. I stared at that gap longer than I'd like to admit. Because this isn't about optimism. It isn't about future earnings. It's about investors willingly paying almost $2 for every $1 of Bitcoin sitting on the balance sheet. On the surface, it feels irrational. If you want Bitcoin exposure, why not just buy Bitcoin? Why pay a 100% premium for the privilege of accessing it through a corporate wrapper? That question pulled me deeper. The answer isn't excitement. It's structure. Large institutional investors, pension funds, mutual funds, asset managers, often operate under strict mandates. Many of those mandates simply do not allow them to hold Bitcoin directly, but they can own public equities. And this company, by design or by accident, became the cleanest equity proxy for Bitcoin exposure available at scale. When I saw major institutional names on the shareholder list, I stopped seeing mania and started seeing something colder, constraint-driven demand. They weren't necessarily bullish on the business. They were boxed in by rules. And that's when it hit me. The premium might not be a mistake. It might be the cost of access. And once I understood that the premium was the price of access, I had to confront a harder question. What happens when access is built on leverage? Because this structure doesn't exist in a vacuum. The company didn't simply accumulate Bitcoin. It financed a significant portion of it through convertible debt. That detail matters more than most headlines suggest. Convertible debt isn't just borrowed money. It's borrowed money with options attached. When those bonds mature, the holders can either demand repayment in cash or convert into equity, diluting existing shareholders. If everything goes well, appreciation masks the complexity. Rising asset values make leverage look elegant. But leverage is neutral. It amplifies outcomes in both directions. What unsettles me isn't volatility itself. It's obligation. Debt introduces fixed commitments into a strategy tied to a highly variable asset. If Bitcoin experiences a prolonged drawdown, the pressure shifts from market optics to balance sheet resilience. Can interest payments be comfortably met? What does refinancing look like in a less enthusiastic capital market? I don't see this as reckless. I see it as structurally fragile, and fragility in finance rarely announces itself before it matters. And that fragility is what makes the final question impossible to ignore. Is this brilliance? Or is this the most expensive shortcut in modern markets? I've gone back and forth on it more times than I'd like to admit. On one hand, if Bitcoin continues to appreciate and institutional constraints remain unchanged, the structure works, the premium persists. Equity holders benefit not just from the asset's rise, but from the sustained demand created by restricted capital seeking exposure. In that scenario, it looks visionary. But this entire setup depends on conditions holding steady. If mandates evolve and large funds are suddenly permitted to hold Bitcoin directly, the justification for paying a premium weakens instantly. The convenience fee disappears. And if market sentiment toward Bitcoin shifts dramatically, leverage stops being a clever accelerator and becomes a magnifier of stress. What I've come to realize is that this isn't purely a bet on Bitcoin's price. It's a bet on institutional behavior, regulatory inertia, and capital flows staying structurally constrained. That's why I hesitate to label it simply as genius or madness. It feels more like a calculated wager on the rigidity of the system itself. And that may be the boldest bet of all. And when a trade depends more on the rigidity of a system than on the asset itself, I can't help but step back and reassess what's really being priced in. So, is this truly the worst trade ever? I don't think the answer is that simple. If the structural constraints remain in place and Bitcoin continues to command long-term demand, this model could continue rewarding shareholders in ways that look almost unfair. In that world, it won't be remembered as reckless. It will be studied as strategic timing. But if access becomes easier, if capital no longer needs a corporate intermediary, the premium that justifies everything could compress quickly. And when valuation relies on a spread that exists because of friction, removing that friction changes the entire equation. What stays with me isn't outrage or admiration, it's awareness. This isn't just a bet on price. It's a bet on how slow systems are to change. And that awareness leaves me with one question I can't ignore. When you look at this company, are you buying conviction in Bitcoin, or are you paying for a workaround built by institutional limits? Sometimes the most important part of a trade isn't the asset, but the structure surrounding it.